morning, and especially when it's trading close to that 50-day moving average, a little bit of weakness there. And then especially with the VIX, I did a taking stock column this morning that looked at kind of what typically, because I think a lot of times October, a lot of people think it's a spooky month when you think about the stock market crashes of 1929 or 1987 or 2008, but it's not the worst month of the year. We know that that's actually September followed by August. It's actually the most volatile. Exactly, not this year though, and it bucked the trend in September, and it was up about 2% last month. So actually, October is the most volatile month of the year by far, and it's about 34% higher when it comes to that volatility compared to other months.
I also want to bring in now what the sectors look like under the surface. Katie, almost every sector here is in the red this morning. There's one sector in the green, and that's energy. It's up by more than 1%, not surprising. Second day of great gains here in Brent prices, New York crude. You are waiting, the market is waiting to see what Israel's response will be to that Iranian ballistic missile attack. At the end of the day, with energy higher, what is the risk for stocks? The first thing you think about is inflation.
Exactly, but the Fed obviously has made it clear that they're more focused on the other side of their dual mandate when it comes to employment. And a lot of times when we've seen geopolitical conflicts, especially in the Middle East, a lot of times when you think about the energy producers in the U.S., for instance, yesterday when we saw that spike higher with crude prices, you saw companies like Exxon and Chevron and other big oil producers moving higher because a lot of times in Europe, they're more dependent, and it's a little bit different when you think about how we're set up here in the U.S. So typically, you might see a particular spike there when it happens, but I don't think the Federal Reserve would be as concerned because it's still, we don't know how exactly all this is going to play out. And especially looking at the options market, they're still more concerned right now about when it comes to employment reports like on Friday versus say the CPI report later this month.
Yeah, it's a fair point there. And you think about what the Fed pays attention to, those core figures, for example, energy, of course, doesn't factor in. But I am curious, you see energy partly because people are hedging right now. That's the preferred way of hedging. And I'm curious, when you're talking to investors, to analysts about these risks that are out there, how are they choosing to hedge? Is it in the options market? Is it buying energy stocks? Is it going into the bond market right now?
Well, even if you look at the put-call ratio from SAPO, right now, even coming into this week, it was actually pretty low and a lot lower than you would expect if you're looking at the 5-day moving average right now. So coming into this week, if you're looking at how hedging was compared to the SPY, obviously the ETF that tracks the S&P 500, it wasn't as pricey as you would probably think it would be. So right now, that tells you they're still not necessarily thinking that there are major risks. But of course, we still have a blitz of earnings season that are going to come October 11th. We'll have JP Morgan and the other banks reporting. You still have the election coming up on November 5th, and obviously 2 days later you'll have the Federal Reserve decision. But right now, when you're looking at as far as what hedging is, it's not telling you that there's that much concern.
One more on inflation. I totally hear you guys on the energy point here, but you do still have a market that is pricing at least 100 basis points worth of rate cuts through the beginning of January, at least, or the end of January, rather, right? So it's still significant. If you don't see those materialize to that degree, what does it mean for the stock market?
Well, I've been speaking with portfolio managers a lot of times, especially when you're talking about swaps, there is more of that indication that they're leaning more towards 50 in the swaps market. But then even if you're thinking about central bankers, depending on if they're signaling, maybe it might not be 50, it just depends on what the data says. Then you'd have to see that type of repricing, because if you think about the last meeting, obviously the swaps market was pricing in 50 basis points, and the Federal Reserve did that. You saw stocks bounce off of that. So it might be a little bit of a different play there, depending on whether or not you see how that shakes out. But obviously, it really depends on the data that comes out the next few weeks.
And if you are trying to trace the indirect route where these energy price spikes that we're seeing factor into the Federal Reserve's decision making, it matters for inflation expectations. You're seeing break-evens rise right now. The Federal Reserve absolutely cares about that. But let's look under the hood here, because of course, at the index level, we're down a little bit this morning. Tell us about what's going on with Apple, for example. I'm going to take a look at those individual names.
Right. So looking under the hood for Apple, it's actually down close to 1% right now. So you did see JP Morgan join Barclays as well as Citi as far as when it was downgrading a little bit of its outlook for when it was thinking about its iPhone unit sales. So it was coming in right now around 126 million units. It previously was 130 units compared to what they had that estimates prior. But also that stock's been up around 17% coming into today and for the year. And also it really had a first tough quarter that I think a lot of people forgot about, especially relative to the S&P 500, but it bottomed back in April and has been on a tear ever since. So when you see it pull back a little bit like that, it kind of makes sense to some technicians that I've been speaking with.
When we look at the hood, guys, today, there's kind of a lot of red on the screen and individual movers. We've been talking a lot about the single stock volatility. I also want to bring you to Conagra here, because you do see it down roughly 7% as the market opens, more than that now. What are the issues?
Right. So this is especially a key space when you're thinking about consumer packaged good companies and what that means for price to mix, because Jen Partashis over at Bloomberg Intelligence has talked a lot about these types of companies, because right now their fiscal first quarter of the profit and sales outlook wasn't as strong as investors were anticipating. And a lot of these companies have had that margin pain just because they continue to have to pass on a lot of those costs due to inflation. And then once again, it did blame those types of inflation issues too. So when you're looking at that, and also not even just Conagra, but if you're looking over at what's happening with other companies that are in the consumer packaged goods space in the S&P 500, that index is actually down a little bit more than 1%. So obviously not just Conagra, but other consumer packaged good companies falling on the back of this report as well.
And we're watching that, of course, materialize, that drop that you're speaking about. Tell me about Home Depot, of course, today. Some sell-side action going on and potentially weighing on the stock here a little bit.
And right now, you're sitting down about 0.6%, but actually it was upgraded to a buy rating at Gordon Haskett. So they actually see potential improvement here in the home improvement type space, just on the back of where we're just talking about the Federal Reserve cutting rates, what that could mean for the mortgage space. But it's been interesting when you think about Home Depot as well as Lowe's, because they are a little bit of a different story. Usually Lowe's is more of kind of a DIY type of kind of project type thing. We saw a lot of that during the depths of the pandemic. But when it comes to Home Depot, and especially with those types of stocks, a lot of that also has been just because those two companies are in the discretionary space. And those two, like discretionary as well as tech, were hit the hardest yesterday because they're more of the growth kind of corners of the market. So I think that's more of kind of it's being kind of holding back those gains, even though it had more of an optimistic rating here.
Yeah, it's a great point. Of course, Home Depot up lightly year to date, but a lot of question marks that are forming over the discretionary space. Just mentioned, it's always great. Just mentioned. Meanwhile, let's take a look at these broader markets right now, still under pressure, actually deepening losses right now. If you take a look at the S&P 500, at the NASDAQ 100, both down about 0.4%. Not really many bright spots to find in this market, especially if you take a look at the Russell 2000. That was your biggest loser on the day, but still off about 0.3%. Mild outperformance if you want to be optimistic, Shanali.
We were talking about most sectors in the red, but I also want to talk about some individual stocks, particularly Humana. The drop is the most since you've seen since February of 2009, at more than 22% lower at the open. There are worries building about Medicare revenue on top of previous worries about costs and tighter reimbursements. We'll keep an eye on that as the day goes. This is Bloomberg.
Jay, what's going to keep me well? This is a frame as the economic picture. The intersection is what you're going to do.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set of what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
The top names in business are on Bloomberg.
The ultimate goal is what everybody talks about. Europe needs stronger banks. Europe needs cross-border. Europe needs banks that are capable to support each industry and the development of Europe so that we are an economic bloc that can hold its own against the US and China.
Nobody covers business like Bloomberg. Context changes everything. Top names in global leadership are on Bloomberg.
OPEC preserved an ideal energy market amid difficult circumstances, crises, and dangerous wars. Therefore, OPEC's policy and its existence is important for the global energy market, and there is a conversation with everybody related to this market and the positive impact on the difference.
In Berlin.
And thank you for organizing this
Jumpstart your trading day with 2 hours of single stock story.
number of items, because I really believe that we are at risk, to be honest. And it's just a word. I think our was completely changed and has to be reset. And when you look at the European model, largely based, by the way, on the strengths of Germany during the past decades, we were based on exports and a big part of the key industry, car making industry, to China. We were based on low-cost energy, Russian gas. We were based on defense umbrella from the US, without any question. And everything now is shaken. China has overcapacities and is clearly a competitive place. So it's no more a secured place for our exports. Russian war killed low-cost energy, and the killer of our competitiveness today is a big gap in terms of energy prices everywhere. This is why we have to completely change our business and have an integrated energy model, because we can deliver with nuclear and renewables, but not without being integrated. And very clearly, Afghanistan, some people are going to have doubt, and the potential change in leadership in the US means that this is not a guaranteed total. So I want to insist on that, because it's super important to assess fairly the fact that our former model is over. And it's not a question of adjustment. This is not the same world, 2024, 2025. And on top of that, we are making the same mistakes on top of the key elements I mentioned. We are over-regulating and under-investing. So just if in the 2 to 3 years to come, if we follow our classical agenda, we will be out of the market, I have no doubt. So I think what we have to deliver in the 2 to 3 years to come is capital market union. My view is that we have to rush on energy beyond what we already decided, which will be implemented for 2026, which will avoid the big peak and the instability of the energy market we had during the past 3 years. We corrected that, but we have to go much faster and further. And we need this investment shock I mentioned. And I think the simplification agenda and let's say, pause in terms of regulation, but even deregulation in some issues, it's absolutely critical.
Can you have any investment? Can you have that investment shock without issuance of joint debt?
I think the best way to deliver is not to create big trauma at the beginning by experience.
But you persuaded the Germans before. Can't you do it again?
It's true, but I was. If I want to be fair, I was a little bit helped by a colleague called COVID-19, and it changed the reality. But I think we have an external systemic shock. I think we have to assess that during the pandemic, we all experienced a symmetric shock for all our economies, and this is why we made this move with Chancellor Merkel. And I think it was a unique move, and this is really, for me, a fundamental change of our EU. Now, I want us to be totally aware of the fact that we are living a symmetric shock on our economies whose scale and magnitude is underestimated. Because the reallocation factor is huge. Look at the chemical industry in Europe, completely being reallocated because of IRA I mentioned. If you don't deliver the level playing field agenda, we will be super happy with REACH as a good regulation for European consumer. But for no more existing chemical industry. And it will be the same for steel. It will be the same for the existing business we have because of energy costs and over-regulation. So we have to fix energy issue and over-regulation. And for me, single market on energy, and on top of that,